Welcome students. So in the process of learning about the financial estimates and projections, next thing we will talk about is preparation of the projected financial statements, we would say. And first statement is the profit and loss account, or the income statement we call it as. And profit and loss account or income statement these days we can prepare in two forms. One is the T format. There we, on the one side we keep the expenses, and on the other side we keep the incomes, and we calculate the difference between the expenses and incomes, or vice versa. If the income side is bigger and expenses is smaller, the end result is the profit. But if it's the reverse, that your expenses are more than the income, so the end result is the loss. Profitability projections or estimation of the working results is an important consideration. And while going to the investors, you have to go with the profitability projections. You have to prepare the profitability statements or income statement or profit and loss account for the next number of years, projected income statement. And you understand, you mind one thing, that you would require certain inputs for preparing these projected statements, and you would be requiring the cost data for the next 5 to 10 years. You require the income data, sales data, closing stock data for the number of projected years going to be there, for which you are going to prepare the projected statements. So you require all the data, and that data will be provided to you largely by the market and demand analysis and the technical analysis. All the projected sales are available with us from the market and demand analysis. That's why we go for the market and demand analysis immediately after the idea generation, because success or failure of the project or any venture largely depends upon the market or demand for the product in the market. When the anchor fruit bear failed in the market, they closed the venture, they lost 350 crores, and they couldn't continue the process because the market rejected the product. And there was no way out at that time to wait for that, to make efforts or to spend heavily on the advertising or maybe to any other effort, because they knew it that this is a product which is not at all required by the people. So even they go for advertising or they try to popularize the product amongst the masses, it will be very difficult for them, because before launching the product, they have to create the market environment for the people to listen or to accept the product like a fruit beer. So it was a very, you can call it as an initial stage at that time, and people's income had started just growing. And at that time, people had number of alternatives. People had tea, coffee, nibu pani, other refreshing products in their hands. Even the cold drinks supplied by the Coca-Cola or Pepsi were also available. So going for the fruit beer anyway, but was not at all an option available with the people, because beer as a word, people hear about something intoxicating product and alcoholic product, and it was not at all alcoholic product, a refreshing product. It's a kind of a drink which is a non-alcoholic drink. So people in India rejected it, and another important reason was that the price was also comparatively higher. It was, I think, comparable to the normal beer in the market. So why should people buy in a country where people have the lesser income, we are price sensitive, we have controlled income, we don't have the money for luxuries. So at that time, fruit beer was considered as a luxury by the people. So company decided not to go ahead with this. They lost that money, they had to dismantle the plant, they had to lose that investment, but they did it anyway. And later on, they introduced the product when the market environment was conducive and people had known about the products like fruit beer and other alternative products in the market. So you have to be very careful that when you go for the market and demand analysis, all sales data is going to come to you from the market and demand analysis. If the market and demand analysis is not correct, is not up to the mark, or you have not got it vetted from the best of the consultants in the market, you have not spent sufficient money on preparing the detailed project feasibility report. So in that case, it's not going to serve the purpose. It means sometimes people say that if the project is going to be worthwhile, if you see the project is going to be a successful venture, then you should spend sufficient resources, sufficient amount on preparing the DPFR, right? So as per some estimates, people say that maybe for preparing the DPFR, if you wanted to be a successful venture, if you want to save your investment, if you want to grow with your investment, you should spend up to 5% of the total project cost on preparing the DPFR, detailed project feasibility report. For example, if the project is of the 100 lakhs, you should spend about 5 lakhs for preparing the DPFR, detailed project feasibility report, and calculate all the information, all the data with regard to the market, demand, cost, and any other kind of the preliminary or pre-operative cost. All kind of the cost should be properly ascertained. Income data should also be properly calculated, ascertained. Best of the consultants should be involved, and if you want to buy the ready-made data, it should be bought from the companies who have control upon such kind of the surveys or such kind of the studies, who are expert to conduct this kind of the surveys or this kind of the studies. Then it would be very good. Otherwise, it's very difficult. If you want to save money on preparing DPFR, if you do not have the proper sales data, cost data, then whatever the projected financial statements you are preparing, they will not be based upon the facts. And many questions will come from the investors at the time of your presentations to them. So they may reject the proposal because your market and demand analysis, your technical analysis are not based upon the logics, the facts, and you may not get the required amount of the investment. Even if they make the investment, maybe they also understand whatever you say or they accept it. Even then the project can fail because your income data, sales data is not based upon the logic or the facts, and even the cost is also not appropriately calculated. At the same time, while calculating the cost, you have to have the scope for the or provision for the contingencies for some unforeseen expenses, because they can also be at any point of time. So you have to be very careful about that. So when you go for the profitability projections, right? So you have to go for example, the sales estimates, sales revenue estimates. What is written here? Given the estimates of the sales revenue and cost of production. Where it is given? It is given in the market and demand analysis, and it is given in the technical analysis. Technical analysis we have all discussed about, that you require to estimate about the investment to be made into the fixed assets, land, plant, building, machinery, civil works, everything, and the current assets may be on the material, labor and other similar current assets. So total cost coming from the technical analysis, total sales revenue is coming to you from the market and demand analysis, and here it is written that the next step is to prepare the profitability projections, right, or estimation of the working results. Right, profitability projections or estimation of the working results, and all the investors require all these projections, and these projections are also useful for the entrepreneurs who are going to create the venture, for you people, and for the investors who are going to be the venture capitalists or the private equity providers, or maybe if it is existing firm and they are going to have the institutional finance, even in that case these estimates are required. So how we go for the profitability projections? For the profitability projections, we start on the top, we keep the sales, expected sales, how much sales are going to be there, where we are going to get it, that is from the market and demand analysis. So we are going to have these estimates from the market and demand analysis. So we are going to conduct this. When you conduct the market and demand analysis, you are going to market, you are collecting the data, you are talking to the people, you are making analysis of that data, you are referring that data and outcome of that data to the best of the consultants, you are getting the market and demand analysis vetted from them, and finally you are arriving at that my sales amount will be certain thing, that in the first year I will be selling something, second year I will be selling something, third year I will be selling something, fourth year I will be selling something, fifth year I will be selling something, like that. 1, 2, 4, 5 years, or you can go up to like this, you can go up to 10 years. So if you have got all the sales data up to 10 years, it means you can rely upon that data because that has been collected in a most meticulous manner. After the sales data collection through market and demand analysis, you have to go for this cost of production estimates, and largely the technical analysis, right? Largely the technical analysis is going to provide you all these estimates of the cost of production, and for calculating the cost of the production, you have to take all the variable and fixed cost. Variable cost is largely on account of the material, labor and your direct expenses, then variable factory overheads, variable administrative overheads, variable selling and distribution overheads, then fixed overheads including factory, administrative and selling and distribution. So all these overheads you have to take, and finally with the help of the cost sheet or statement of the cost, you have to work out this cost of the production, right? This is the second important thing. Into this cost of production, you have to add some indirect cost. If you have not added into the cost sheet, if you have already added into the cost sheet, this is a administrative expenses, then don't need to add it here. But if you have not added there, sometime what we do is we prepare the cost estimates in the cost sheet up to the factory cost, right? up to the factory cost. So after the factory cost, other overheads we separately estimate. But in the cost sheet, for example, if you have included all the overheads like your prime cost you have calculated, factory cost you have calculated, cost of production you have calculated, and finally you have calculated the cost of sales. So in that case, the addition of the administrative expenses is not required. And similarly, you talk about the total sales expenses. So once we have already prepared the cost sheet, right, statement of the cost. So we have already calculated all the costs. We have calculated the prime cost also, right? So that we have seen in the previous class. Then we have calculated the factory cost, and by adding the factory overheads, then we have calculated the COP, cost of production, and then we have calculated the cost of sales. All the costs we have already calculated. So when all the costs are available with us, so it means that cost of sales or the total cost we have calculated. So in that total cost we can add, if it is required, the royalty and know-how payable, if any cost has to be paid on this account, royalty or the on account of technology. For example, any annual expenses have to be made to the say technology suppliers, know-how suppliers. We have not made the one-time payment. We are going to make the annual payment as a royalty. So that has to be added into that. And finally, it will give us, right, that is the cost of production, administrative cost, total sales cost, and royalty. So B, C, D, and E, this will give us the total cost of production. This is going to be the total cost of production, right. If you have already prepared the cost sheet, then this cost will directly come from the cost sheet, and that will work out as total cost of production. So now in the profitability projections in the income statement, you will take part of the information from the cost sheet, and or you will work it out at the time of preparing the say this income statement or profitability statements. And if it is already there with the cost sheet, so we will take it from the cost sheet. So you have the sales data on the top, you have cost of production with you, and finally the difference between this A and F is going to be the gross profit, right? Gross profit before interest. Gross profit is basically a rough estimate between the total sales revenue and the total cost, total manufacturing, and you can call it as the administrative and selling cost. So this is the difference between the sales revenue and the total manufacturing cost, and the difference we call it as a gross profit. Why it is a gross profit? Because this is not the final divisible profit. This profit is not available to the entrepreneurs or to the owners of the business or to maybe any other stakeholder. From this profit you have to make certain additions, certain more incomes have to be added, which are called as indirect incomes, because we have two kind of incomes in a firm. One is a direct income which comes from the sales. Second is a indirect income which comes from the different sources. I will discuss with you at the appropriate time. So total income means in this gross profit we will add the indirect income, and we will subtract some indirect expenses also which are not already say subtracted. For example, the financial expense, financial cost, that's the interest cost. We have to subtract that. Depreciation as a part of the fixed cost, part of the cost of the asset, means depreciation of the asset has to be further subtracted and from the gross profit. And then maybe from the gross profit, when you subtract these two things, from G when you subtract H and I, H is the total financial cost, means the interest cost, and I is the depreciation cost. So you arrive at something which is called as the profit from operations or operating profit, right? You arrive at the operating profit, and into that operating profit you have to add up the income, other incomes. Other incomes can be, for example, you have surplus funds. These funds are invested somewhere outside other than this business, so it's giving us interest. So that interest on the investment is the another source of the income, which is not an operating income, but yes, because the funds belong to the firm, they have been invested somewhere outside, so that income belongs to the firm, so that has to be added. For example, this firm trains the employees of the other firm as apprentices, and that other firm whose employees are trained by this firm, so they will be paying them apprentice training cost. So that cost will be the indirect income. For example, they have surplus premises, space available, and that is rented out. That's not used for this business because we have some surplus space. We don't want to make use of it. We don't have a proper use for that. So the rent coming out of that is another source of income. But largely the other incomes are not with the startups, right? They are with the existing firms when they go for expansion, diversification and control. So the existing firms can have the other incomes, or the projects being brought up by the existing firms, they can have the other incomes. But in the initial years, startups or new ventures, Standalone ventures will not have any extra income, and for them the major source of the income is going to be only the sales revenue. And from that, maybe the total operating income which we have calculated, operating profit, if other incomes are there, we will add up the other incomes, and then we will be say subtracting the preliminary expenses. Preliminary expenses are basically non-cash expenses. Two expenses are not non-cash expenses. One is the depreciation, this is non-cash expense, and second one is the preliminary expense. This is also a non-cash expense. We call them, these two expenses are the non-cash expenses. Why? Because no cash moves out of because of these expenses. For example, if you buy raw material and you want to say have that raw material for your manufacturing process, you have to pay to the supplier immediately. You have to pay to the supplier, or maybe you have to pay on the later date if it is supplied on the credit, but cash will move out. If you have the labor working in your plant, so certainly that labor has to be paid, so cash will move out of your plant. But for example, when you talk about the depreciation expenses on what? That's on the, say, the part of the fixed assets which are used for production in that particular period. In that particular period, that is called as a depreciation. It's a part of the fixed cost added to that particular years of the volume of production for calculating the cost of production for that volume. So we have already paid the price of the fixed assets when the assets were required or acquired by the firm. So at the time of acquisition, the cost has been paid. Now through depreciation, we are recovering that cost, so that tomorrow when we have to replace that asset, when its technical value will become zero, we will have the sufficient funds available. So at the moment, depreciation is only a book entry and no cash is moving out at the moment from the profit and loss account. So it's expense but a non-cash expense. Same is the case with the preliminary expense. Preliminary expenses are incurred before that idea is accepted, or maybe the project is given a shape. For example, idea generation. You have multiple ideas, and for screening and arriving at one idea, you conduct a lot of research studies, you refer it to the experts, you take the help of consultants and all that. So you pay expenses, they are called as the preliminary expenses. For registration of the firm, for example, we decided that yes, we'll go for this venture, we will convert that idea into the business. So we have to register it as a private limited company or a partnership firm or something like that. You have to prepare the partnership deed, or you have to prepare the memorandum of association, article of association. So you have to register that company as a private limited company, as a business. So you have to incur some expenses. So these are called as a preliminary expenses. So these expenses we are not incurring today. These have been incurred in the past. Only we are recovering these expenses now. So they are also the expenses, but the non-cash expenses. So they are only book entries, but yes, we have to make these book entries. So preliminary expenses, depreciation, we have all to take into account. And after adjusting for these expenses and other incomes, you arrive at that at this point, and this point is called as a profit or loss before taxation. So if the total income is more than the total expenses, so it means we are at the state of profit. But if it is the vice versa, that the total expenses are more than the total incomes, we are at the state of loss, right? So we have to work it out that. And how we are going to work it out? J plus K minus L. J is the operating profit, K is the other incomes, so we are adding it up, and L is the preliminary expense. If it is there, we are subtracting it. So we are arriving at, that is the profit before taxation, or taxes to be paid to the government in the event of the profit. And then the provision for the tax. So provision for the tax would be only applicable if there is a profit. And after paying the taxes to the government, that is M minus N, you will arrive at something called as the profit after tax. And from that profit, if it is a company form of organization, so we will have to pay the dividend to the share capital providers, to the capital providers. So there could be preference shareholders, there can be equity shareholders. But in case of the startups, all these are not there. Right, the only capital comes from the entrepreneurs as well as from the venture capitalists, angel investors or private equity providers. So these things are not applicable. But if it is a firm, for example, if it is registered as a public limited company in the beginning itself, because it's launched by some large sized organization. For example, these days, Aditya Birla Group is coming out with the new division of manufacturing paints. Opus is the brand name. Right. So Opus itself is a company which is miscreated, which is a subsidiary of the Aditya Birla Group. and they have created this subsidiary. So it's already right from the beginning itself, they are in the company form of organization. So if they earn any kind of the profits, and if they have used the share capital, if they have used the IPO, and the funds have been raised by issuing the capital to the general public in the market, and company is listed in the stock exchange, in that case there could be preference share issued to the public, equity share issued to the public. So they have to be paid to the they have to be paid the dividend, which will be paid out of the profit of the firm. After paying to the capital providers, means some return on their investment in the form of dividend, we are left with the remaining part of the profit, which is called as a retained earnings or retained profits. You call them as a retained earnings also. You call them retained profit or retained earnings. So it is also there, which is now to be retained by the firm. And after that, we'll have to work out the total cash flow, and total cash flow is basically sum total of three things, and these three things are, for example, the profit. Means profit, which part of the profit? This is the retained earnings, then plus your depreciation, which we have already calculated, we have subtracted, so it's a non-cash expense, and then we have some preliminary expenses. So these three things are there, which will give us a total cash available with the firm, and this cash will be transferring to the cash flow statement, and through cash flow statement we will be working out the closing cash balance available with us. That should match with the balance sheet also, and that should match with the bank balance which we have in the bank, or the passbook balance also. So cash book and passbook balance should also match. The closing cash balance given in the balance sheet should also match with this cash balance, and from here, from the income statement, we will go to the cash flow statement, we'll show it there, and we will work out the closing cash balance. So retained profit, retained earnings are a very important component which provides the internal sources of the funds. In the previous classes, sometime I was telling you about the Grasim Industries, and I told you that Grasim Industries has the initial capital of the 91 crores, right? And today the balance sheet size is 70,000 crores, right? The total size of the balance sheet is 70,000 crores. So it means after only investing 91 crores, the company's balance sheet size is 70,000 crores. And when we saw that debt equity ratio is just 0.47:1. It means they have not borrowed sufficient money from the market also. So what is the source of this balance sheet up to 70,000 crores today? So the source, largely the funds, because total debt equity ratio you see here, that for example, if they have invested 1 rupee from their pocket as a equity capital plus a retained earning, so they have only borrowed 47 paisa in the form of the borrowed capital from the financial institutions. So the total amount is 1.47, or maybe if you say the 100%, so in this 100% stake, larger part has come, more than double has come from the internal sources, and only less than half has come from in the form of the borrowed capital. So it means if the borrowed capital is also very less, initial capital is also very less. So how this balance sheet size has become 70,000 crores, and so this has become because of the retained earnings. Means larger part of the profit is reinvested back into the business. Larger part of the profit is reinvested back into the business, and this is a very good financial strategy. Initially, as an entrepreneur, you should not think of taking out the larger part of the profit and pocket it. If you want to grow in the market, means if you want to establish yourself in the market and you want to convert your startup into a transnational company tomorrow, so you should have a financial strategy like that. Larger part of the profit you should reinvest back into the business. Even if you turn up tomorrow into a public limited company from a startup today, if tomorrow it becomes a public limited company, it starts growing, it becomes a national company, it becomes international company, it becomes a transnational, multinational and transnational company. Even in that case also, you should have a policy that if you require the funds internally for the growth, diversification and expansion, don't pay any kind of dividends. Ask your shareholders that we need the funds internally and we are not going to pay you the dividend. Or if you want to pay the dividend, pay a very lesser amount of the dividend to the shareholders. Convince them that we want these funds internally for our growth, expansion and diversification. So you have to go ahead with this financial strategy. And anyway, it's your money, is going to grow with us. And if you're not getting the liquid income, your total equity value is going to increase. Your shareholding in the firm is going to increase. That way also it's your money, your share in the firm is going to increase. So we will not be means looking for the external sources of the funds. We will be generating the funds from the internal sources, and that way you are getting the easy access to the finances from the internal sources. You are not depending upon the external sources. You are not borrowing the capital. You are not raising the debt on the firm. You are not increasing the distress level of the firm, and you are very easily means diverting your retained earnings towards your further expansion, diversification and growth. Many companies, Reliance is a classical example. In the initial years of their growth, they never paid a dividend to the shareholders, and as a result of that, in a very short span of maybe little more than 50 years, they have become the second largest industrial house in the country after Tata Group. So the growth of the company is really spectacular, and their financial strategy, apart from many other things, one important strategy was that larger part of the profits they invested back into the business. They paid very less amount of dividend. Initial years they didn't pay any dividend to the shareholders, and they convinced the shareholders that your money is safe with us, your investment is safe with us, allow us to be used within the business and allow us to grow and to multiply your resources. They did that, and today you see where the Reliance Industries are, and that as a group maybe they have outsmarted that more than 200 years old of the Tata Group. So miss that can be the financial strategy, that can be the approach, that even a startup can be taken up to that level if you have the right kind of the financial strategy. So retained earnings play a very critical role, and if you pick up the balance sheet, on my suggestion you pick up the balance sheet of the Grasim Industries, you will find it that their initial investment is very less and total size of the balance sheet is 70,000 crores, and if you calculate the debt equity ratio, that's not even 0.5:1, it's less than that. So it means they have kept their borrowing capacity reserved, and they have largely depended upon the internal sources of the funds. So profitability projections are very helpful. They are going to guide us that how the profits of the firm are going to be, what is going to be the trend of the profits of the firm, and how you are going to means grow with your business over a period of time. If you have the good profitability projections, it will not be difficult for you to raise the funds from the venture capitalist. So here is it's the statement I am going to show it to you now. This is a profit and loss account, and this is in the T format, right? This is in the T format. So you are dividing it into the two equal halves, and in these two equal halves you have the say trading and profit and loss account of XYZ Limited for the year ending on 31st March, some year, which year you wanted to have. This will also, I will also discuss with you that why this is 31st March. Can it be any other date also? That I will discuss with you in the subsequent class. So this is the format. We just can have an idea about this format, that we have the particulars and we have this debit side. DR means debit, and this is the credit side. CR is a credit. So we have on the left hand side we are putting all expenses. This is a direct expenses and direct income from the sales and closing stock, and the difference is GP, that is a gross profit. We have seen in the previous slide also gross profit. Then the gross profit, because it's income, so it comes to the credit side here, and it's a gross profit. In this we add up some other incomes also. We subtract some other indirect expenses also on account of financial account or depreciation or others, and then we come at a figure that is called as a true net profit before tax, right? Net profit before tax, and then we subtract the corporate taxes from this, and finally we arrive at the figure which is called as a net profit after tax. So this is the total of the income statement. This is a T format. We divide it into two equal halves, and this becomes T. So on the debit side, left hand side is a debit side. We keep all expenses. On the right hand side, this is the income side. We keep all incomes. So it's a comparison. This upper half is a comparison of the direct expenses with the direct incomes. So this is the direct expense and this is a direct income, because whatever the production you make, that will go to the market, we will sell that. So sales value is the income, and any production which we made here but it's not saleable, it is still with us, it will be going to the market in the next period. So it is called as a closing stock. So total we produce this, we incur this much of the cost, and the difference is the gross profit. So it is called as the direct income, and comparison between the direct income and direct expenses. Net result is a gross profit, and then you come to the lower part, and lower part is the indirect incomes and indirect expenses, and net result is a net profit. So this net profit is after paying the taxes to the government, it's available with us, net profit after tax. And from this profit, if it is a public limited company, you have to pay the dividend. After paying the dividend, now that remaining profit will be retained earning with us. So this is a T format of the income statement. And this is a vertical format of the same income statement, where on the top we keep the sales or we keep the revenues. So it becomes the total revenue. Sales will give you the revenue, and from that if you subtract the expenses, so all expenses will be subtracted, total expenses will be subtracted. So this will become the profit before the income tax. This will become, in this profit before income tax, you will add some exceptional incomes which are not very regular incomes. Exceptional incomes are once in a while. So some exceptional incomes we will add up. So it will give us the profit before tax. From that we will subtract the corporate tax. So it may be some part of the tax which you are going to pay, which is at the moment in the current year, that is called as the current tax. Some taxes deferred, that's a different story. Deferred taxes, you can read on the deferred taxes. So some taxes are deferred, and finally we calculate the profit for the year after paying all taxes, and that is a net profit after tax. So these days many a times you will find many companies are preparing the financial statements in the vertical format. This is the vertical format, or the previous one is the T format. Either way you can prepare it. The more convincing it is, you feel like, you can prepare the projected financial statement. And people are mispreparing in the vertical format. If you see, if you open up any company's balance sheet these days, you will find they are preparing in the vertical format. So either way it is correct. And finally, this way you are preparing the projected income statement or profit and loss account, and with the help of this projected profit and loss account or income statement, you can communicate in the presentation to the investors that how your firm is going to behave as far as its incomes and costs are concerned, and what is the net result over a period of time, when you are, till what year you are going to incur the losses, when you are arriving at the break even point, and after which year you are going to earn the profits, and what is the trend of the profit. So this is all about the projected profit and loss account or projected profitability statements, and remaining discussion on the other two statements, that is a cash flow statement and the balance sheet, that I will have in the next class. Till then, thank you very much.